All right, welcome to our Meet the Pros. My name is Beth Sykes, and we are here tonight. We have Michelle Sadowasser from Eastmont and Tamara Caldwell-Burns and Jared Gronin from this, my brain went blank, from the county, sorry. And then we have Kyle Meisner here from Cordell, Neer and Company, and he is going to be sharing with us tonight about paying taxes and answer some questions that you guys might have. I'd like to welcome everybody online as well. And folks that are in the room, if you have a question, there are microphones on your table. You'll need to push the button in order to make that green or that red light turn green. And then once your question is done, if you will push that button again, then the mics won't pick up any table noise. So we are glad to have you, Kyle. Thank you.
Glad to be here. So, okay, we'll jump right in here. Quick disclaimer, this is general advice. If you need something specific to your particular situation, you should ask your own tax professional. That's a lot of words to say that. A quick blurb about our firm. We're one of the largest local firms in Wenatchee. Out in Old Station, there's about 40 of us doing tax, financial services, and accounting work. So we'll jump in to the tax stuff first. So first question is, who needs to file? If you are single or single dependent and you have income over $13,850, then you have a tax filing requirement. If you have unearned income over $1,250 and you're a dependent, then you also have a tax filing requirement. If you have net self-employment income of over $400, I know that's under the married filing joint, but that's for single or married, then you would also have a requirement to file a tax return. If you're married filing a joint return and your income is over $27,700, again, you have to file a tax return. Can you clarify what that means? Yep, we'll dive into that here a few slides down the road. So it's possible that you might want to file a return, even though you don't have to. So a couple things that would start you down the path to wanting to file a return. The first one would be is if you had some federal tax withheld from your wages or other earnings. So you can't get that back without filing a return. So if you have had withholding from your wages, depending on how much it is, it probably makes sense to file a tax return to get that back, even if you don't have to file a return. Conversely, if you made some estimated tax payments, you need to file a return to get those back as well. So if you've got something paid in and you want to get it back, you have to file a return to get it. The IRS won't just send it to you. There's some credits out there that you might qualify for, and we'll dive into a few of these a little deeper, but the earned income tax credit, child tax credit, child independent care credit, some of the educational credits, and there's a premium tax credit. Those are going to be probably mostly for parents, except for maybe the earned income tax credit, but certainly a few different reasons that you might need to file a tax return, even though you don't have to because you made less than those income numbers that we talked about on the last slide. So what is earned income? That's wages, salaries, or tips, basically anything on a W-2 or net earnings from self-employment. So that's going to be probably reported to you on a 1099 NEC. Unearned income is almost anything else. So interest, dividends, Social Security, unemployment, and rents are all examples of unearned income. So The easiest way to think about it is if it's on a W-2 or a 1099 NEC for non-employment compensation, then it's going to be earned income. Pretty much everything else is unearned income. Questions on that? So now, for parents, what qualifies as a dependent? So qualifying child is a lineal descendant or foster child, or a sibling or half sibling, under the age of 17 on December 31st. And they have to live with you for more than half of the year and be a citizen or resident. A non-qualifying dependent is also a lineal descendant, no age requirement. And then so for those folks, you have to provide over half of the support. So side hustle income, this would be your Uber Eats or DoorDash or any of those things. Typically, you're going to get that income reported to you on a 1099 NEC. If it's over $600, you need to include all of that income, including any tips you receive. That's going to get reported on Schedule C on the 1040. Important to note here is you can deduct any expenses that you incur and generate in that income. So fuel, insurance, repairs on your car, or standard mileage, your cell phone, anything, any expense that you incur to generate that income, you can use to offset that. And as long as it's active, so you get that 1099 NEC, you can generate a loss and actually have a deduction. But if you do get that 1099 NEC, even though you may have a loss, the IRS is going to be looking for a tax return. So that would be another one of those times where even though you don't owe any tax, you're going to want to file a return because that 1099 has been issued. So the IRS is going to be looking for that tax return. So the child tax credit, as of right now, it's $2,000 per qualifying child in 2023. So that is a lineal descendant or sibling under the age of 17 as of December 31st of that tax year. Sorry, 17 or under. Those folks are going to get you a $2,000 credit. Up to $1,600 of that is refundable. There's a bill bouncing around in DC that might make that $1,618, and it would potentially increase again next year. But as of today, $1,600 of the $2,000 is refundable. What that means is if you had no tax liability and you claim a qualifying dependent child, you can get $1,600 more than what you paid in back. So that it sounds kind of funny to say 1,600 of that is refundable, because if you have tax liability, the entire 2,000 may be refundable, but $1,600 more than your tax liability, or if you had no tax liability, you could get up to $1,600 back, even though you had no liability. That may change, but as of now, $1,600. For those non-qualifying dependents, the credit is $500, and that's non-refundable. So if you have no taxable income, you don't get the $500 back. As long as you do owe some tax liability, that $500 can generate a refund for you. So that non-refundable is kind of a quirky IRS term there, but $2,000 for 17 and under, $500, 18 and over, providing they meet those support tests. So the child care and dependent credit is available for 20 to 50% of your qualified child care expenses, up to $3,000 for one child or $6,000 for two or more. Qualifying child is somebody under age 13 or a spouse or other individual living with you who is physically or mentally incapable of self-care. So if you have a qualifying child or dependent and you pay for their care, and that when they're unable to pay for them care for themselves, you can get a credit. Your care provider must provide you their name, address, and tax identification number or social security number. So the IRS matches this up to their return. So if your other child or grandma's doing it for some money under the table, they might not like you very much if you report that to the IRS under their social security number, because they're going to be looking to match that up. But if you're paying a business or somebody on a regular basis, there is a credit available for that care. The earned income tax credit. So if you work and you earn income under $63,398, that's for a family. So for an individual, that amount's going to be less. But if it's under $63,398, you may qualify. You also have to have investment income under $11,000 to qualify. There's some special rules for disability benefits. If you have disability insurance and you're under retirement age, that counts as earned income. Unfortunately, SSDI, SSI, and military disability do not count as earned income. So kind of talking out of both sides of their mouth there on what's earned income and what's not. But if you earn less than that 63,398 and you're not a dependent, it's worth looking to see if you qualify and get that earned income tax credit. So kiddie tax, if you have a dependent with unearned income over $2,500, that may be subject to the kiddie tax. And really all that means is that income gets taxed at the parent's tax rate. So the IRS set this up so that parents couldn't open an investment account in their kids' names and pay at lower tax rates. Again, examples of unearned income: interest, dividends, capital gain, unemployment, Social Security. So if your dependent has those unearned income sources and they're over $2,500, be aware that their tax return and yours is a little bit more complicated because their income gets taxed at your rates. So a couple resources for filing tax returns. There's the IRS free file at irs.gov. So you choose one of their qualifying free file providers and it walks you through the steps, asks you some questions, and you can file for free through those providers at the IRS website. You have to meet some income requirements. Most kids that are working, it's going to be easy to meet those requirements. There's also a new IRS direct file program this year where you can actually fill out the forms on the IRS website and submit them directly. That's also free. The volunteer income tax assistance program is out there. The closest one is in Ellensburg, so not a huge help, but they're out there and they can help to answer your questions. You can use TurboTax or another online provider or software provider. The tax forms are available online at irs.gov, or you can, if you get in a pinch, call one of the local CPAs in town, and we're happy to help out. Certainly happy to answer questions. So this was new last year, the Washington Working Families Credit. Sorry, it's pretty small down there, but the income limits are the same as the earned income tax credit. So if you are at least 25, actually, if you're between the ages of 25 and 65, and you get the earned income tax credit, then you also will qualify for this Washington Working Families Credit. You can apply online through the Washington Department of Revenue, but this is another credit out there for some folks. So this is it ranges from $315 to $1,255, and it's pretty straightforward to apply for that online through Washington DOR.
Question. If you have more than 3 qualifying children, is it still capped at $1,255?
Yes, 3 is the most dependents.
And is that refundable?
Yes, this is a refund straight from the state to you. So a quick note on estate and gift taxes. If you die with more than $12,092,000 in net worth, you're going to have to, or your estate and heirs is going to have to pay some tax to the IRS. So there's also the gift tax exemption, which plays into this estate tax exemption. So if you gift more than $17,000, that should say 2023. Sorry, I missed that one on the slide, but the amount is good. In a given year, then you have to file a gift tax return. Fortunately, it's another quirky description by the IRS, and it's really a reporting requirement. There's not going to be any tax due unless you gift more than $12,092,000 in that year. So if you make a gift of $17,001 or more, you have to file something with the IRS. They call it a gift tax return and they call it a taxable gift. But practically speaking, unless you gift more than $12 million, there's not going to be any tax due. You're spending on that lifetime exemption. And then for Washington state residents, Washington has an estate tax that's 2.193 million of net worth. So if you die with over that much, your estate's going to have to pay some tax. There's no gift tax for Washington state. So many folks that are older do some gifting to reduce their Washington state estate tax liability. But that gift tax is a question we get often. People think that they're going to have to cut a big check to the IRS if they gift over 17,000, when in reality it's a reporting requirement only. So if you do need to set something up for your child down the road, don't be afraid of that gift tax. It's really a filing requirement and not an actual tax due unless you're gifting more than $12 million, in which case you're probably not too worried about paying some tax. So we'll go through this quickly on taxable and non-taxable Social Security. So Social Security disability is based on work history. Supplemental Social Security is provided to disabled adults and children of limited income and resources. Generally, neither one is taxable unless your benefit and other income is more than $25,000, but less than $32,000, then it's half taxable. So like everything with the IRS, there's some math that goes into figuring this out. If your total income plus benefits is more than $32,000, then 85% of the benefits are taxable. So the takeaway here is under $25,000 of benefits plus income, none of it's taxable. Between $25,000 and $32,000, half is taxable. More than $32,000 combined income, 85% is taxable. Survivor benefits or back payments can sometimes push you up to where you increase your taxability of those benefits. And neither one of these is considered earned income for calculation of the earned income tax credit, like we talked about earlier. So a couple notes on SSI qualifications. You have to apply it with DSHS. The Spokane office covers our area. At age 18, there's an evaluation to determine whether you're going to qualify. And there's some limits on how much folks who qualify can earn and still get a benefit. So for 2023, you can earn $1,550 in substantial gainful activity. So that's wages. And that's per month, unless you're blind, in which case you can make $2,590 per month. And then your unearned income, the limitation was $914 in 23, and it's $943 in 2024. On that unearned income, like we talked about, interest, dividends, and capital gains. So questions on any of that? We went through a fair amount pretty quickly, but happy to answer any questions if there are any. Doesn't look like there's anything, so I will leave my contact information up here. If anybody online has any questions, they can feel free to reach out to me. I'm happy to answer. The earned income exclusion for SSI qualification. So $1,470 a month for 2023, $1,550 per month in 2024 is how much you can earn and not affect your benefits. And then unearned income, so interest and dividends, $914 for 2023, $943 for 24. So if you can earn quite a bit more as long as you're working than you can in that unearned income. This one. So the takeaway there from the survivor benefits is that it may make your other Social Security benefits taxable in the year you get it, because it's typically a bump in income. So it may take you from not paying any tax on your Social Security benefits to paying 50% or 85%, because that would all hit in 1 year, potentially, if you get a lump sum payment or some back payments. Anything else? Okay. Perfect. Thank you.
That's it. All right, thanks you guys for coming. Please eat pizza.